Let me say something that might make you uncomfortable. If you're using an S corporation, there's a very real chance that every paycheck you run is either quietly overpaying tax or quietly building IRS risk. And here's the worst part. Most business owners don't know which one they're doing. Not because they're careless, not because they're aggressive, but because no one ever explained what salary actually does inside an S corporation. Today, I'm going to do exactly that. If you've ever thought, I'll just increase my salary a little to be safe, or I'll keep it low and deal with it later, this video is for you. Because the IRS doesn't care how you felt when you made that decision. They care whether your salary makes sense on paper to someone who has never met you.
So you're saying my salary choices might be wrong in both directions? That's comforting, in a stressful way.
Exactly. And here's the core idea you need to understand first. Salary feels expensive in an S Corp because it is expensive by design. Not emotionally expensive, structurally expensive. There are two separate tax layers built into salary. Once you see them clearly, everything else starts to make sense. Layer 1 is payroll tax. In an S corporation, when you pay yourself a salary, you're not just getting paid as an individual. You're standing in two roles at the exact same time, employer and employee. That distinction is easy to gloss over, but it's where the cost starts. Because when those two roles overlap, the IRS doesn't treat the salary lightly. That single dollar of salary is subject to a combined 15.3% in Social Security and Medicare tax, the employer portion and the employee portion together. And this happens before we even talk about income tax. So before that dollar ever reaches you, before it hits your bank account, before you decide what to do with it, it already took a hit.
So payroll is like the IRS saying, nice dollar you have there, let's split it.
But that's only the first layer. Layer 2 is personal income tax. Because once that salary clears payroll, it doesn't disappear into some separate category. It follows you. That same salary dollar is fully included in your personal income. It stacks on top of everything else you earn, which means it's taxed again, this time at your federal income tax rate and, depending on where you live, possibly state and local rates as well. So the same dollar that already absorbed payroll tax now gets exposed to income tax on your return. That's why, in an S corporation, salary isn't just expensive. It's layered expensive, not because the IRS is being aggressive, not because you did something wrong, but because that's exactly how the structure is built.
So every time I say, I'll just raise my salary a bit, the IRS says, perfect, walk with me.
This is where most people go wrong. They don't start by asking, what does my role actually justify? They start with a very different question. How low can I push this and still feel okay? And that shift matters. Because the IRS never asks what made you comfortable. They don't care what felt reasonable when you ran payroll. They ask one thing, does this salary make sense based on what you actually do inside the business? Not what you intend to do, not what you plan to do later. What you are doing right now. From the IRS perspective, salary isn't a reward. It's an explanation. It's how the business explains why money is leaving the company in the form it's leaving. In an S corporation, salary is not a tax strategy. It's not there to optimize. It's not there to make the numbers look cleaner. Salary exists to answer one very specific question. What do you actually do for the company? If the business would slow down when you stop working, salary simply reflects that reality. It's the mechanism the tax system uses to connect income to effort, to show how value is being created inside the company. When that connection is clear, the structure makes sense. When it isn't, that's where questions start.
So salary isn't there to make me feel clever. It's there to make my story believable. Okay, that hurts, but fair.
So if there's no formula, how does the IRS actually evaluate salary? They don't start with a calculator. They start with the explanation. Specifically, they look at the method you use to justify the number. In other words, how did you arrive at this salary, and does that process make sense to someone outside the business? There are 3 common approaches the IRS recognizes when reviewing compensation. None of them are shortcuts. None of them work in isolation. Let's walk through them. Method 1 is the cost approach. This is one of the most straightforward methods the IRS uses because it focuses on what the business would actually have to pay if you weren't there. The question is simple. If you stopped working tomorrow, how much would it cost to replace the services you provide? Not your title, not your ownership percentage, not how you describe yourself, just the real work being performed, the day-to-day responsibilities, the decisions that move the business forward, the oversight, coordination, and execution that someone else would have to step into for the company to keep operating the same way. In IRS terms, this is often called the many hats analysis. If replacing you would require multiple people, that directly supports a higher level of compensation. The cost approach forces the IRS and you to view your role as a bundle of services, not a status. If the business would realistically need more than one hire to replace what you do, that matters here.
So basically, how expensive am I to replace? Yeah, I regret asking that.
Method 2 is the market approach. This approach looks outward instead of inward. The IRS asks, what would a similar business pay for similar services under similar circumstances? This is where salary surveys come in. Industry benchmarks. Government data like the Bureau of Labor Statistics. These tools are useful, but only when they're used correctly. Because a market number by itself does not explain your role. It doesn't account for how hands-on you are, how many functions you cover, or how much the business actually depends on you. Two people with the same title can have very different responsibilities. That's why the IRS treats market data as supporting evidence, not a standalone answer. Without role-specific context, it's just a number on a page.
So copying a Google salary chart and calling it reasonable, yeah, that doesn't sound audit-proof.
Method 3 is the income approach, often referred to as the independent investor test. This method looks at results. It asks, after paying the owner a salary, would a hypothetical investor still be satisfied with the return on their investment? This is where people often tie salary to a percentage of revenue or profit. And to be clear, percentages are not automatically wrong. The problem is when the percentage becomes the explanation. A percentage doesn't describe the work. It doesn't explain the role. And it doesn't tell the IRS why that number makes sense based on what you actually do in the business. On its own, a percentage simply reacts to results. If revenue goes up, the salary goes up, even if your responsibilities didn't change. That's why the IRS does not treat percentages as sufficient by themselves. They can support an explanation, but they can't replace one. If the only reason your salary changed is because revenue went up or down, that's a signal the explanation may be weak.
So if my salary changes just because Stripe had a good month, yeah, that feels fragile.
So now you understand how the IRS evaluates reasonable salary. Here's what often triggers the next question. Many S corporation owners receive an IRS notice called CP-261. Let me be very clear up front. CP-261 is an IRS notice. It is not a new tax law, and it is not a salary formula. What CP-261 does is simple. It tells you that the IRS has accepted your S corporation election based on Form 2553. That part hasn't changed. But recently, the IRS has made something else much clearer. Once your S Corp status is confirmed by notice, your business becomes more visible to the IRS as an S corporation. And when that happens, the IRS pays closer attention to whether S Corp rules are being followed correctly. One of the first areas they look at? Reasonable compensation. So CP-261 doesn't change the rules, it changes the level of attention. Strong, defensible salary analyses never rely on just one method. They usually combine three things: cost approach as the backbone, what you actually do and what it would cost to replace you, market data as support, to confirm your salary falls within a reasonable external range, income context as a reasonableness check, to make sure the results still make sense to an outside investor. When these three align, your salary stops looking like a guess and starts looking intentional. Some people pay more tax not because it's the best structure, but because sometimes paying more tax isn't about compliance. It's about buying peace of mind. Remember this, a reasonable salary is not calculated. It's explained. Ask yourself three simple questions. Can my role be replaced? What would that realistically cost? Would an outsider understand this salary? If the answer is yes, you're thinking the right way. If every time you run payroll, you quietly think, this should probably be fine, that's your signal to stop guessing and take a closer look. Save this video. And if you want me to go deeper, comment one word: salary. This content is for educational purposes only and does not constitute tax, legal, or financial advice. Please consult your CPA or tax professional for guidance specific to your situation.